Welcome to America's Commercial Real Estate Show, your source for market intel, forecast, and strategies. Hello, I'm Michael Bull. Thank you for being with us. The show today is brought to you by CommercialAgentSuccess.com. Check it out for the ultimate and commercial broker training. Power your sales meetings. Learn more at CommercialAgentSuccess.com. Well, today we're going to talk about a subject that I know most of our audience is very interested in, and that's multifamily, the apartment world. What a great run apartments have had for many years now. But what's happening lately? Of course, transaction volume in most every class of commercial real estate has been down maybe 50% on average around the country for 2.5 years. But what's happening lately with the Fed lowering rates a little bit, 10-year floating around and changing, new president in office, tariffs, what's happening with transaction volume, what's happening with rents, what's happening with new supply. Let's find out that and a lot more. Please welcome my guest. It's Greg Willett. He's Chief Economist, and Andrew Bowen, Senior VP of Strategic Partnerships, and they're both with LeaseLock here in Studio One. Thanks for being here, guys.
Great to be in the studio.
Thanks for having me back, Michael, which means I probably wasn't terrible the last time I was here.
No, that's right. Gosh, you've been on the show a few times, I think. So that's it's great to have you back and be here in Studio One. Well, first, let's talk about something that I know that's close to the heart of all of our listeners, and that's transaction volume. No matter what you do in this business, the transaction volume kind of makes the wheels work. Greg, what do you see and what do you expect moving forward?
I certainly came into this year thinking that transaction volume would get a little bit stronger than it has been. And I'm feeling better about that prediction as we are moving on through the year, particularly given that 10-year treasuries have come down a little bit. That had been an obstacle to getting some deals done. But I think that volume is going to accelerate as we go through the course of the year. A couple of factors there. I mean, a lot of money that is sitting on the sidelines, really ready to come in to the market. And at the same time, everybody's pretty confident that market fundamentals are going to improve rapidly in 2026 and 2027 because of the decreasing supply volume. So you want to get some deals done to take full advantage of that run up that is probably ahead of us. And so I think there's a little bit of FOMO, fear of missing out, that you want to get those deals actually in the pipeline and get them moving.
And that makes sense, right? Because new supply has really slowed down.
Yeah, the start volume is really low compared to the completion volume. That gap between starts and completions is biggest it's ever been. So that means while we're struggling a little bit with deliveries right now, that's not going to be the case in 26, 27.
Yeah.
By struggling, you mean because we have so many deliveries, not because we're struggling to get deliveries done, right?
Maybe a little bit of both, but certainly it is the volume that we're delivering right now. It makes it tough to absorb all that product at once. I mean, there is certainly a housing shortage. We need this product, but to have this much finishing at one time is a little bit challenging. But also, I mean, to your point, Andrew, the deliveries are being delayed from where they were scheduled. And it is a challenge just to get the construction workers on site and to really get that product across the finish line.
Yeah. And what does that mean for rents? If rents have maybe kind of flattened a little bit in a lot of markets, right? But with a lot of deliveries that kind of going on right now. But what do you expect for rents moving forward if new supply is dwindling?
Certainly, we've seen in most markets, I mean, relatively flat rents over the last couple of years, beginning to show a little bit of an uptick in the country overall right now. I thought that the performance would get meaningfully better this year. There are some headwinds, though, that are emerging. So I'm getting more confident about transaction volume. I'm getting maybe less confident about overall market fundamentals for the very short term. But I think we do clearly have substantial improvement in rent growth that's coming in 26 and 27.
What are some of the headwinds that could hurt performance? Is it affordability for the tenants, or
It's a little bit about what's happening in the economy overall, but particularly I would cite that consumer confidence is losing steam very quickly, and that can certainly alter the behavior of renters and make them a little bit less willing to go form additional households. And so that suggests that our overall demand number this year, which I think will be solid, but maybe not quite at the level that we thought it was going to be as we came into the year, that uncertainty then has a different impact on the existing base, and that renewal lease activity, that I think that the ability to hang on to the current residents is going to get stronger and stronger. And you look at those numbers a lot, Andrew.
Well, yeah, and this is where I was going to say that that's where the headwind can actually become a tailwind, depending on what part of the market segment you're in. As this uncertainty continues within the economy, yes, people are going to be much more apt to stay where they're at as opposed to the uncertainty of where they're going. Is that going to hurt the new supply that's coming in? Yes, probably. Is that going to help existing product that's already stabilized? We're already seeing through Q1 a premium of about 350 basis points in the renewals that we're seeing, the renewal conversions we're seeing in multifamily overall, relative to the January and February averages over the last 15 years.
Wow.
So this isn't just like a one-time thing. It's a significant difference that we're seeing people staying in place. Again, to your point, I think that creates the headwind on the new supply where that's got to be absorbed. Existing supply, that actually can be a tailwind from a rent perspective.
And there's this big economic impact for these operators, right, on turnover?
It's huge. When you think about it from an NOI perspective, I look at it two ways. Number one, you've got the cost of actually turning the unit. And there's been several different recent surveys where that average cost is, let's call it $3,800. I'm rounding down just a little bit. Just to make up that rent difference would be huge. But I did an analysis using RealPage Market Analytics where we can see actual lease over lease transaction based data. And over the last 15 years, including during COVID, there was actually 117 basis points premium for someone staying in an apartment versus someone leaving. So you take that premium and not having to turn that unit, throw that at a 5 cap on a 300 unit building, you're talking about, basically $250,000 of valuation you've either preserved or created, depending on how you think about it, for every point of retention you can drive.
Keep your tenants, people.
Absolutely.
And it's important to realize also that those retention numbers vary by that type of product.
Sure, absolutely.
And certainly the lower the price point, the higher the retention just in general. So these higher retention numbers can really help that middle to bottom end of the product spectrum.
Yeah. One of the things that I was always conscious of when I saw rents for many years going up, sometimes 10% a year, I'm like, well, salaries aren't going up that fast. What about affordability for tenants?
I think maybe people have not processed that incomes have actually gone up more than rents have over the last couple of years. But, that doesn't mean that we don't have affordability challenges. And the share of households who have to spend a pretty sizable chunk of their total income on housing, that's growing all the time. So those affordability challenges are there. We're very focused on some challenges for the renters overall, and not to turn it into a commercial, but that LeaseLock replacement for a deposit certainly helps. Andrew, if you want to talk about that a little bit.
Affordability is an issue, and definitely the share of wallet that housing overall takes is a big issue. But to Greg's point, number one, it is relatively segmented. If you look at the overall numbers that I saw yesterday, it's about 25% of the average burden of rent to income. With that also said, I think that those paying over 30%, which are considered rent burdened, is 40% of overall. So there's definitely some extremes on this. And when you think about the deposit side of the equation, which is where we typically step in with a zero deposit alternative through issuing basically a lease insurance certificate to the owner of the property, we can remove that burden of being able to move. Bankrate's latest survey, when they survey Americans and see, okay, how much cash can you have to cover an emergency or an unexpected expense of $1,000 or more, 57% of Americans can't do that. You think of coming up with first month, prorate, moving costs, a deposit, affordability is an issue.
Yeah. I just heard of a friend tell me that they had to go get a loan to rent an apartment.
Oh my gosh.
With the moving cost, right? And the utility transfer setups and the security deposit for the apartment and the first month's rent and all of that. I thought, that's terrible as well, but it's affordability can be an issue.
Yeah. Digging into those affordability numbers a little bit deeper, I mean, something that I keep an eye on is the overall credit card debt and how much that has been rising over the past few years, and particularly that's coming from middle tier to bottom tier income households, and that we are certainly seeing a pretty rapid rise in overall credit card debt, which for the U.S. overall is like $1.2 trillion right now. And the delinquency rate is beginning to nudge up a little bit. And then, of course, the interest rates on credit cards are so astronomical compared to other types of debt that is where we can see some early warning signals of consumers getting a little bit overstretched at this point.
Yeah. What about the reports we all hear in our industry, and then people who are not in industry, is there's not enough housing, and you mentioned it earlier that we need housing, but although at the moment maybe we have a lot of Class A vacancy at the moment in some of these markets, how low are we on housing supply, and is something being done about it?
We're certainly undersupplied in the big picture, and I'm the nerdy stats guy, and depending on the source of information you look at, these numbers are widely varied from
I love this portion of it.
We're about 1 million units short of what we need to we're somewhere from 5 to 7 million short of what we need. I mean, that's a huge range. Yeah. But whatever, I'm in the camp of, I think the number's about 2 million housing units short. But whatever the methodology you're going to use, we're clearly short in the big picture. But at the same time, we're delivering a lot of product right now. And I tend to relate this to the weather because it's easy to understand. We might have, in the big picture, have a drought, but if it rains a lot in one day, we can't handle that and we get flooding. Yeah. So on the multifamily side, particularly in Sunbelt markets, we're flooding for the moment. Yeah. But again, as we look at just a year from now, we're going to be delivering far, far fewer units. And those big picture shortages are become clearer.
I want to expand on part of what you said there, because it's not just that we're, and I love the range 1 to 7 million apartments. It's just hilarious. But it, just like we talked about with income levels, it really is the segment of the market that we're the most short in. Yes, we're delivering all this Class A stuff. Why? Because it's the only stuff that pencils out. So what are we doing about it? I have hopes about what we're doing about it is we're going to make the little A or workforce housing much more affordable to actually build, whether that is through the removal of the hurdles that we actually experience from a governmental expense perspective. Scott Turner, the new Secretary of HUD, has done a lot of work within opportunity zones. There's been a lot of recent analysis on just how successful that program was, and I hope it gets revved up again. And then, not to timestamp this episode, but the Wall Street Journal came out with an article yesterday that really evaluated the potential plan to use federal lands and opening those up for potential development. I was of the camp that I didn't know how much that would actually help because of where federal lands are located, but 7% of the federal lands are located in highly impacted submarkets and markets today. So I think done well, that's another program that can help a lot.
Yeah, I think that's important. And I think the federal government has a lot of property,
Yeah.
office, everything, right? So that maybe there's some help there. What about the demand for multifamily rental based on home sales? What do you expect moving forward? I guess interest rates have come down a little bit for home buyers. How's that impacting the rental market?
Certainly people are who traditionally would have been buyers are staying in the rental market longer than they would have in the past. And certainly you can see those numbers if you listen to REIT earnings calls. Their loss of renters to purchase is really low by historical standards.
Mhm.
So that is helping the overall demand number for apartments, but it's not the biggest factor that comes into play there. I think maybe that gets overstated a little bit. So a positive for the industry in terms of creating some demand, but it's moving the number after the decimal point. It's not really making a drastic difference in what's going on in the marketplace.
Yeah. Well, the apartment communities must not be afraid of that anymore. I have a loft apartment here in Atlanta because my home's 43 minutes north of here. And they invited a residential real estate agent to come in and supply treats for all the residents. So, and talk to them about buying houses, I presume. What else would a residential agent talk about? And the community's like, it's fine with us.
And also point out that it's not a competing situation there. That when you have strong home sales, that really feeds the economy and helps create jobs for people who do rent an apartments. And usually a strong for sale market means a strong rental market, not vice versa.
Well, and as a recovering operator, like I always looked at the people who had buying homes. That was a life change. Like there's nothing I could do about the life change within your business. It's the other, I always say 33% are going to leave no matter what. 33% are going to stay no matter what. It's the other 33% you're fighting tooth and nail for. Yeah. And if you're going to have a life change, congratulations.
Yeah.
Good, happy for you.
That's good. So for buyers today in the marketplace, you do expect more transaction volume, more sellers kind of okay with maybe interest rates aren't going to drop below kind of historic averages, anymore. So sellers okay, but buyers, I think from what you're saying earlier, buyers, it could be a great time because they might see some rental increases in 26 and 7.
Yeah, that's certainly true. And I'll also point out that, again, we've delivered all this new product over the last couple of years and will continue to do so this year. So in terms of the top tier Class A space, there's a lot of really attractive product that is available or is becoming available this year that would be really great long-term investments. I think it's a little bit more challenging as you move down the product spectrum at this point. And I think the transactions this year are going to be very heavy on that top tier space.
Good. Well, I hope so. I'm coming out with a 300 unit Class A, very, very nice, very stable. And then I'm coming out with a 100 unit kind of Class C plus. So I don't know how much activity we'll have for that one, but probably a lot because it's in Atlanta. So we'll see.
I think if we're going to see some of those Class C properties move, frankly, that's because we're going to see a little bit of distress emerge in that segment of the marketplace.
And that one is distress. It's for a bank.
So Greg, I'll hijack for a second. Are you worried at all that all this capital that's sitting on the sidelines is going to take their ball and go somewhere else from an investment perspective? Or do you think they still have the patience after 2 years to still sit there?
I think in the big picture, institutional money still really likes multifamily. I will say that they are also looking at some other products, maybe more so than they did in the past. The one that I would really keep an eye on would be data centers are now emerging as a pretty attractive alternative to place some capital, and industrial is still highly in demand as well. Um, are we at the bottom for apartments or for a office? Let's fingers crossed, but that's the one that's clearly been out of favor of late.
Yeah. Well, based on the interviews we do on this show and the surveys of the folks that we interview, multifamily seems to be very attractive still to people. And I think a lot of it's because of what you're saying here, that there's a shortage of housing. And even if we have a influx of too many units right now, that's about to change.
And I also think it's interesting the markets where this capital is going to go. And there is and it's happened gradually over the last decade, but you can really see it if you do the comparison on those numbers of the capital moving away from highly regulated markets to the less regulated environments, which that helps the Sun Belt in particular.
Yeah, and I assume it helps affordability, right? It seems like some of you get these markets, you get rent control, and all of a sudden there's no new supply, and it makes the problem worse.
Yeah, I mean, yes. Whatever you step in on the regulatory side to try and help the consumer, that just means the developers are going to go somewhere else.
Yeah, it makes it worse.
Yeah, Minneapolis is a great example of that a few years ago.
Yeah. Well, where are there some advantages, where some opportunities maybe for developers or investors for this year?
Well, I think that we've certainly hit the bottom on the start volume. So I do think that is going to begin to improve a little bit, not skyrocket, but there is a little bit of money available for development that's beginning to enter the system there. And so I would look for those numbers to begin to move. For investors, a lot of times it's know your local markets, know the neighborhoods. There are places where I don't love the metro numbers, but once you get down into some of the neighborhood plays, there are a lot of attractive spots to go to.
Yeah. Good point. We just brought out an acre of land across the street in Atlanta from the largest aquarium in the world. And it's interesting to see some of the developers looking at that and think, well, right now I wouldn't want to deliver, but if I'm going to deliver in 3 years, it might be perfect, right?
Yeah. Well, I'll talk to you later. I'm trying to figure out where that acre of land is because
right,
I know that area.
Yeah, it's a parking lot now, paid parking, and it's right across from the aquarium. So, well, what would you leave our audience with, guys, to think about for multifamily this year?
I think it's a transitional year that we know that 26 and 27 will be very favorable. We know that the last couple of years have been a little bit of a struggle. This year, we're in that middle ground. So, but you know what's coming as we get to the next couple of years. So get ready for that and get in front of the curve.
Andrew?
I'm much more, like I said, recovering operator. So I go back to how to operate properties. Don't sleep on your current resident base. Yeah. You know, the business of real estate obviously is transactions, but the business of running properties is hospitality. And the owners that understand that with their operators drive the ultimate amount of valuation increase on a property.
Yeah. And I liked the idea you had earlier when we were talking that operators should maybe go be a resident.
Yeah, so I had an opportunity in between homes about 2 years ago to actually live on, it happened to be a BTR site in Dallas, and it opened my eyes again to what the resident experience really is. And I've said it before, but I think what we count, 5 different apps that I had just to manage my apartment. And this was not a high-end building in any way, shape, or form.
Yeah.
And I had refused to download the 6th app because I can plug in numbers. I'm Gen X into a key code.
Yeah. Well, and you mentioned build to rent. Is that impacting the multifamily apartment market? You guys seeing that?
It's a different renter typically.
Yeah.
So, does it have some impact?
Mm-hmm.
Yes. But it's by and large serving a different audience. But as we said, that people are renting longer and longer, and that's helping overall rental demand. And as the renters age, they do have a tendency to go to that BTR product.
Mm-hmm.
So from an investment perspective, I don't think it's affecting multifamily much yet. There's only about 225,000 or so that are actually delivered in place right now.
Mm-hmm.
Where it absolutely is affecting multifamily right now is operations. The idea of being able to operate a 150, 200, 250 unit property with minimal staff through centralized or specialized operations is something that the operations side of the business is talking about constantly. Mm-hmm. Every organization of any size is adjusting right now to figure out how they redo their operational model to make sure they deliver maximum service at a minimum on-site presence. So in that regards, I think it's very much affecting the industry.
Yeah, good point. If folks want to reach you guys, what's your website there at LeaseLock?
It's really complicated. It's leaselock.com. So LEASE.
How am I going to remember that?
Yeah, it's a tough one. But yeah, leaselock.com is like.
All right, guys. Thanks for being on the show. We appreciate it.
Appreciate you, Michael.
Thank you, Michael.
All right. And thanks for joining us around the country. You heard it. If you want to reach out to them, it's leaselock.com. I remembered it. That's fantastic. And thanks for joining us. Thanks for your comments. Thanks for sharing the show. And if you need anything from me, you need any real estate folks or anything around the country, reach out to me. I'll try to find the right person for you. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.